think I will. Good afternoon, everyone. My name is Monica Warren Jones. I'm the Director of Capital Solutions for Enterprises Mid-Atlantic, or our DC office. I am here to welcome you today for our Equitable Path Forward webinar series, Affordable Housing Debt Executions, Acquisition Refinance versus New Construction and Sub-Rehabilitation. Before we get started, I will be introducing you to our presenters, but I want to give you just a quick little background on Enterprise and our Equitable Path Forward program. So, our mission and our vision is that one day every person will have an affordable home in a vibrant community filled with promise and the opportunity for a good life. Our mission is to create an opportunity for low and moderate income people through affordable housing in diverse, thriving communities. Next slide. So Enterprise's approach, what really sets us apart from our peers and in the industry, is how we work. We have a proven and powerful nonprofit that really improves communities and people's lives by making well-designed homes affordable. So for the past 35 years, we've created nearly 500 million homes. We've invested $36 billion, and we've touched millions of lives. We're the only social enterprise in the United States with deep expertise in each of three catalytic areas for systems change. We do capital, we direct public and private capital, we aggregate capital, and we make sure that more than $36 billion is delivered to support the development of low-income communities across the U.S. Through policy, we are a crucial voice for America's low-income communities with a strong presence in Washington, D.C. and in city halls across the country. We have a strong policy advocacy arm in all of our local markets, which really helps to support and advance best solutions for housing and from a policy framework. And then in terms of solutions, we work with local partners to test and scale new solutions to some of the most pressing housing and economic problems facing low-income communities. Next slide. So this series that you are about to be a part of is part of something called our Equitable Path Forward. We designed this program to basically build the capacity of Black, Indigenous, and people of color and other historically marginalized housing providers. The Equitable Path Forward program aims to close the gap through a $3.5 billion effort to support BIPOC and other historically marginalized housing providers by helping them to build capacity through both their technical knowledge and know-how, as well as capital, to help create and preserve affordable homes in diverse communities. We have a $350 million growth fund that will provide debt, equity, grants, and innovative credit enhancement that will help to attract an additional $3.1 billion of capital. So we are seeding something that will hopefully leverage the attraction of other investments. And then we are also working with a $15 million program to cultivate local development organizations and small businesses. And we are also in the process of developing a leadership program. So what I would be really helpful if folks are comfortable, if you don't mind self-identifying both race and ethnicity, only if you feel comfortable. We really want to make sure that we are sort of targeting our programs to help support the development of folks of color in the marketplace. And if you don't mind putting that in the chat, again, it's by volunteer. We'd really appreciate it. Next slide. So again, a little bit more about EPF. It's a 5-year initiative. It's multi-pronged. We're really trying to fill that gap of capital that has been lost in the marketplace or not been available because of systemic racism. We want to strengthen our providers and our partners' ability to provide the best-in-class services through some of the programs we have, including our advisory services and other non-financial support, including programs like this. And we are really interested in making sure that we can do our part to create new career pathways for leadership in the affordable housing or in the real estate industry. Next slide. So now I'm going to turn it over to our presenters, Lundat Casa and Anthea Martin, who come from our Bellwether Enterprise debt platforms. They will be providing you with some key and critical information, and will set the agenda for today. I think Lundat, take it away.
Thank you, Monica. Appreciate the introduction and the opportunity to present here. Let me just share my screen quickly. Okay. And so thank you again. Like Monica said, Anthea and I are with Bellwether Enterprise. And we have an agenda here where I'll go through the introduction of Bellwether Enterprise, talk about our history, our production, our platforms, and then we'll then dive deep into the various debt execution platforms that we have, particularly through the agencies, Fannie and Freddie, and HUD, and direct purchase program. So about Bellwether, Bellwether is one of the few mission-driven full-service commercial and multifamily mortgage banking companies in the nation. We have a unique ownership in being a subsidiary and a mission partner of Enterprise. Enterprise is a majority owner of Bellwether, and the rest of the ownership is Fifth Third Bank has a minority ownership, and key bank employees also have minority ownership interests. Bellwether is a for-profit subsidiary of Enterprise. We provide a broad range of capital sources. We're a direct lender through all the major government and quasi-government sources, Freddie, Fannie, HUD, and USDA. We also have internal and external bridge sources, partner with banks, CMBS pension funds, and we have relationships and correspondent agreements with 65 plus life insurance companies. The real estate asset types that we operate in are also diverse. We provide financing for market rate and affordable workforce apartments, seniors housing and care. This includes licensed seniors housing and care, so assisted living, memory care, skilled nursing facilities, and then commercial real estate asset types, office, retail, and so forth. And so Bellwether was founded in 2008 with 12 employees and just not a whole lot of servicing under its belt. And it's grown in 2020 to over 343 employees and $7.5 billion in volume cap completed in 2020. So it's been an exponential growth, which we're very happy and proud of. And a substantial amount of it is also in affordable housing space. The merger with Enterprise occurred in 2012, so that history is also pretty lengthy at this point. The vast majority of loans that we provide are in multifamily, so over 60% of our loans are in the multifamily space. And our major capital sources are the agencies, life companies, but also FHA and rural, the USDA program, rural housing, and CMBS and other platforms. So I will now pass it off to my incredible colleague, Anthea Martin, and she'll discuss affordable housing.
Wonderful. Thank you, Lundat. I appreciate that. I have to say, I am very proud. I feel very proud being here today. It is wonderful having a partner like Enterprise. They're extremely mission driven, and their mission aligns very well with my own personal mission, as well as the mission of Bellwether to truly provide as many tools as possible in the affordable housing space. And I feel that we are extremely unique in that sense. We have more tools to specifically target affordable housing than any other lender that I know of in this space. Today, I'm going to be presenting on affordable housing debt executions. I'm going to do my best to go slowly through this and to make it digestible for the audience. I'm going to break it up into two sections: acquisition and refinance, and new construction and substantial rehabilitation. Before I get into that, I'd like to say that I'm the Senior Vice President with Bellwether Enterprise. I'm with their Affordable Housing Group and FHA Group. And I've been in the industry for over 20 years. I'm extremely passionate about affordable housing. I serve on the Colorado State Division of Housing Board as their chair, and also the Housing Colorado Board also as their chair, as well as many other local nonprofits and real estate diversity initiatives, frequently volunteering in that space as well. So extremely proud to be in this space. So I'm going to be speaking about the requirements for our affordable housing programs. As Loondot mentioned, in the affordable housing space, we mainly have Fannie Mae, Freddie Mac, and FHA, which we're direct lenders of, as well as RD. We also have our own private placement program, and under the private placement, we have several investors in that space. On the conventional side, we have many more products which Loondot addressed, but I'm going to speak specifically to affordable housing transactions with an emphasis on bond deals, so 4% LIHTC deals. So in general, as a developer, if you are looking for a non-recourse permanent loan option or construction to permanent loan option, in general, you'll need a net worth of 50% of the loan amount or a liquidity of 10% of the loan amount. So in terms of who the players are in this space, it varies depending on state. I am from Denver, so I'm going to speak a little bit about the HFA here. We have CHFA, but whatever your local FHA is, they will likely have resources for you. Bond allocation, of course, but in addition, they'll have some mezzanine programs perhaps that might be helpful for workforce housing, or some type of risk sharing program potentially that is a good fit if you might have a 9% deal or a smaller 4% deal that perhaps is not a good fit for any of the programs that we're going to talk about today that Bellwether Enterprise offers. The banks are great options as well, especially if you're in a CRA market where there's a high demand, a high need for for affordability. The banks, if they have a CRA interest in your transaction, then they will be interested potentially in being a direct investor on the equity side, as well as the construction and permanent debt lender if the state allows for that. The government agencies are also huge players in this space, being FHA, HUD, and RD. If you have a project that is eligible for USDA RD 538 financing, that's an excellent tool to use alongside any type of bond transaction as well, or 9% deal. And then finally, the agencies, which we put under the agency umbrella, really it's Fannie Mae and Freddie Mac. They're extremely mission driven as well. So I'm going to start with the acquisition and refinance bucket here of all the tools, because everybody loves a good rehab. So in general, again, the terms are going to range debt service coverage ratio of 1.11 to 1.15. Loan to value is going to be 80% to 90%. The amortization is going to be 35 years and the loan term 15 to 35 years. Now, when I talk through some of these options that we have, I'm going to go through the pros and the cons of them, but do keep in mind, these are transactions that don't have new tax credits on them. So there is not going to be a new tax credit deal. They would not have had tax credits placed in the past 3 years. It's, for example, a year 12 or 15 deal that needs to be refinanced. You need to pull cash out to pay off your equity investor, or you're looking to do rehab, or it could be just 100% Section 8 transaction as well. Anything that has restrictions on it. So to start off, we have the Freddie Mac Moderate Rehab Program. So this program is great if you have tenants in place and you're looking at doing a rehabilitation. It also works well with a long-term HAP contract. So if you have Section 8 there, project-based Section 8, this program is fantastic because it has a lower cost of issuance with no bond underwriter, no rating agencies, no fees, etc. No fees. There's no program like that. No rating agency fees. Processing time is about 75 to 90 days. And this program will allow for a much higher renovation per unit. One of the cons of this program would be that to date, pricing has been less competitive than Fannie Mae's MBS structure and HUD's 223F, which we will go through here in a minute. The next option would be a HUD 223F. So with HUD, you have two program options. It's for market rate as well as for affordable housing. You have the 223F program, which is the refinance and acquisition program. And then you have the 221D4, which is the new construction and substantial rehab program. So with the HUD 223F, many changes have been made over the past several years, which now allow for much higher renovation per unit. So you could do what's called a heavy F and really build in a substantial amount of repairs and still be considered a refinance and not need to comply with Davis-Bacon and some of the extra items requirements that are required by the 221D4 program. Under the 223F, the loan to value increases to 90% for properties that have 90% or more Section 8. So you're always going to find the best terms really with HUD, with any of the agencies, with our private placements, the deeper the affordability is. This option offers an extremely low interest rate. Just to give you an idea, right now we're in the low 2% range for the interest rate on a 223F. And then on top of that, you do have an MIP for an affordable transaction. Your MIP is going to be 25 basis points. This also offers a very long term, so it's a 35-year loan term. While most of the programs that we're talking about here in this category have a 35-year AM, the HUD program is one of the only ones that offers a 35-year loan term. The negatives here is time to close. It takes a while to get through the HUD process. You have to be patient. We're seeing some longer queues than usual with HUD, so you really have to be prepared for this to take longer than usual. I'd say in a typical environment for an affordable transaction, we were looking at about 6 months from the time of application to the time of closing. And now you'd be looking definitely at least 9 months. And there are higher reserve requirements. So because it is a 35-year term, HUD really wants to position the property to be extremely well maintained for that whole period. And so you will see much higher reserve requirements with the initial deposit to replacement reserve, as well as the ongoing reserve requirements because of that factor. Next, we have the Fannie Mae Preservation Program, or the MBS. So this is a mortgage-backed security product. This is it is eligible for a 9% and a 4% tax credit deal. This would be great for tenant in place rehab of any existing affordable housing stock. It also works well with the long-term HAP contract, a shorter processing time when compared to HUD, and lower interest rate as well. So the Fannie Mae Preservation product is a little bit lower right now than likely our Freddie Mac option. I'd say you're looking at mid 3% range for this option, and the lender is going to serve as the direct underwriter. So we are a DUS lender, which means we are a direct underwriter and servicer for Fannie Mae, which means that the risk is delegated to us, and that the benefit to you as the developer or owner is that we do the underwriting, we submit it for approval, but they're not re-underwriting what we do. They delegate, they give us the authority to make the underwriting decisions. The negatives there is that there are strict MBS guidelines with Fannie Mae. They tend to be a bit more conservative when it comes to strength of the borrower, experience, as well as location. And they do require an initial pre-review, which can take a little bit of time to get through that process with Fannie Mae. So the next bucket that we're going to go through here is the new construction and the substantial rehab program. So these will assume that you have bonds allocated and that it is a 4% LIHTC deal. I'm not going to go into detail on 9% executions in this presentation. Reason for that is typically the 9% deals that we do are much larger, and most of the smaller 9%, you're better served with a small 9% to go directly to a bank or perhaps to your local HFA. So assuming that bonds are tied to these transactions, you will get the absolute best terms because it's bond financing. The debt service coverage ratio range here is between 1.11 to 1.15, with 1.11 the lower end there. That's going to be offered through HUD. on properties that have Section 8 financing or Section 8 half contract. The loan to value, 90%. With the HUD 221D4, it's not value constrained, it's a cost-based program. So the range there is 87 to 90%. Again, with 90%, the more attractive term there being tied to a Section 8 deal. The amortization is going to range from 35 to 40 years. You're going to see that you'll be able to tap into that 40-year AM if you're in a really prime location, you're a prime borrower, et cetera. With the agencies, with our private placement product, 40-year AM is standard. The loan term range is going to vary between 15 to 40 years. 40 years is going to be on the HUD side when you're dealing with the HUD 221D4. However, since we're talking about bond deals, most of our clients want 15 to 17-year term to allow for an LP exit. So the first program I'm going to talk about is the Freddie Mac tax exempt loan program. This is a tax exempt loan. This is not a bond deal. So there are a lot of advantages with it being just a tax exempt loan versus the bond. We'll go through some of the bond options here after this. But before I get into this specific program, you could see up top here, I highlight that it's a forward. I'm sure many of you know what a forward is, but for those of you who don't, the two buckets that I'm going to be talking about as debt, permanent debt options for bond deals is going to be either immediate funding or a forward. So with a forward loan, you are closing on that forward permanent debt loan at the same time that the construction loan closes, which means you're hedging your interest rate risk for that entire construction loan period. There is a bit of a pricing premium. So if I were to price a tax exempt loan, or a TEL is what we call it today for you, as an immediate execution for a stabilized asset, it's going to be, you're going to have a much better rate than if I were to price a forward, which assumes that we're really not funding on that forward loan until 24 to 30 months out when the project is fully stabilized. So with the tax exempt loan, you have fewer participants. It's a loan, it's not a bond transaction, so you have no investment banker, there's no rating agency to deal with. Because of that, you have much lower soft costs. So you've got about 40% less soft costs when compared to one of the bond programs. The processing time is about 90 days from application to closing, very low replacement reserve. So standard is about $250 per unit. There's no need for a bridge loan because you have that construction loan in place. Now for the construction loan, you're coming to the table with your favorite construction lender, or we can help you. We have several partners that we work with, and we can get you several quotes on the construction loan side as well. With this TEL program, one of the benefits is there's no Davis-Bacon wage requirements. In terms of the cons here, you will need a separate construction loan. So there's an additional party at the table with all of their own fees and attorneys, et cetera. It's not approved in every state. It is approved in most states, but there are a handful of them that don't allow for tax exempt loans at this time. And then the legal costs can be fairly high with this program. In terms of pricing on it, we'll go through at the very end a brief snapshot of a case study that shows you some of the side-by-side pricings. The Fannie Mae MTEB. So this is a tax-exempt bond deal. So this is bond financing. With the bond financing, you're going to have those additional soft costs, but there are a lot of pros that go along with this particular program that's offered by Fannie Mae. It is securitized on the back end by an MBS. The processing time is 90 days from application to close. Very low rate. Again, we'll go through the rates later. And in this instance, as I mentioned previously, we are direct DUS lender, direct underwriter servicer for Fannie Mae. So we serve as the direct underwriter, which just helps in terms of dealing with back and forth at the end of the day. No Davis-Bacon wage requirements, no bridge loan is needed. Similar to the TEL, this loan is not funded until your project is fully stabilized. The stabilization test for all of our programs is 90 at 90, so 90% occupancy for 90 days. All that being said, you are taking some conversion risk when you're doing a tax exempt loan or one of our or the Fannie Mae MTEB because it's a forward. So you're actually not getting funded until you're stabilized. And if you don't meet that stabilization test, we're not funding. Negatives here, cons, you do need that separate construction loan. So in addition to having an investment banker, rating agency, et cetera, at the table, because this is a bond program, you also will have your own construction lender. So a lot of parties involved here. There are some strict MBS guidelines that we have to abide by. This is a short-term bond structure, which means it has a higher cost of issuance. There is going to be negative arbitrage here. The bonds are going to be fully funded on day one. So you have whatever your construction period is, 24 to 30 months. You have that whole period where you're going to be accruing that negative arb. We do offset that with a cost of issuance reimbursement. So Fannie Mae will provide a 75 basis point reimbursement at the time of conversion, but that's a little bit down the road. So something to keep in mind here with all of these options, it's very deal specific. So depending on the strength of the borrower, the location, the actual size of the deal, it will come into play which one of these options we're talking through today is going to be the best fit for you. So the best way to really know what works best for your deal is to send us a pro forma, and we'll do a side-by-side comparison, set up a call, and go through the pros and the cons in that way. Must have LIHTC, so bond transaction, you absolutely have to have the tax credits tied to it, where that tax exempt loan structure could work for a 9%, for example. And then, as I mentioned, it's more participants here. There are more participants here. So the next is the HUD 221-D4. And as you can see up top, this is a construction to perm loan option. So this is not a forward loan. You don't need to come to the table with your separate construction lender. It is a streamlined product. I'd say that is the biggest plus, is you're not taking conversion risk. You're locking in at the time the construction loan closes an excellent rate, and with a 2 handle today. And it really, you cannot beat the pricing, the proceeds that HUD offers. So that's obviously one of the positives there. Absolutely the lowest rate available that we offer. Tax credits are not necessarily required. This option could work with 9%. It could also work with a market rate property. So there's, as I mentioned, no conversion test. It is a streamlined construction to permanent loan and longer term. So 40-year AM, 40-year term, regardless of the market. That's just standard with their program. And this is a cost-based program. So you're going to be constrained from 87% loan to cost to 90% loan to cost, depending on how deep your affordability is and whether or not you have Section 8 HAP contracts on the property, but just maximum loan terms. The negatives here is you will have to abide by Davis-Bacon wage requirements. So if your property is greater than 5 stories, you're abiding by commercial Davis-Bacon wages. If it's under 5 stories, it's residential, which can be substantial in some markets, especially the commercial Davis-Bacon. Time to close here with the D4. On an affordable transaction, you're able to bump the line and be ahead of any other type of transaction in terms of processing in HUD's queue. But as I mentioned previously, we are seeing longer queues than we typically would. So even with an affordable deal, I would say be prepared for a bit more time than usual. This is the biggest hassle factor with HUD, is that you have to be able to stomach the time. So with a 221-D4 affordable deal, you're really looking at about 9 months to get through it, in 6 to 9 months in a perfect world. But with some of the delays that we're seeing, I'd say you might be closer to 9 to 12 months. You will likely need a bridge loan here to bridge the equity as it's phasing in. It is certainly a higher cost of issuance in a lot of instances. We also have some negative ARB here for this option. Yeah, I can't emphasize enough. I mean, there certainly is a high hassle factor. You have to make sure that your entire team has that specific HUD 221-D4 experience. With an affordable deal, you have a little bit more leeway, but you really want to make sure that your GC, your architect, and your management company are very HUD savvy. It will make your life much easier as you go through that process. And one last thing I want to emphasize is you absolutely want to make sure that your lender is HUD savvy and has strong HUD relationships in the office that you're working in, the HUD office. The last option here is direct purchase of bonds. So this is our private placement program. This is also streamlined construction and permanent loan in one. We have several investors here, which is nice. When we first started this program about 3 years ago, we only had one investor. And now that we have others, we've seen our pricing really come down on this. It takes about 90 days. It's a fairly streamlined, easy process to go through. 90 days processing, application to closing. It's easy because you're cutting down on the parties involved. You don't have that construction lender, separate construction lender, and that really helps keep some costs down as well. So 40-year AM is standard here as well. The lender also serves as direct underwriter, which helps with that ease. What I've seen with a private placement is they have been more flexible than any of our other lending partners. So if you have any nuances in your deal, just to give you an example, there's a client I have who had a lawsuit on his transaction, and really none of our other lending partners wanted to move forward because of the risk there. But our private placement investors were okay with it. They hedged the risk with the rate. So we were able to execute well for him. So anything where you have some flexibility, or you're anticipating that your rents are going to increase significantly in the next year, and you really want to take advantage of that projected higher AMI increase, anything outside of the box of private placement would be really good to look at. So no bridge loan is required here. As I mentioned, most flexible option, and no need for a separate construction loan. So Bellwether Enterprise will end up servicing the construction loan, handling all of your draws. Now, with all of these options, we are the servicer. We do underwrite. The difference would be when, for example, when we're underwriting for HUD or for Freddie Mac, we submit to them, and sometimes they'll come back and they'll have criteria that they'll want to see changed or adjusted in the underwriting. So with this private placement product and with Fannie Mae, we control the underwriting. Negatives, cons here is that this is incorrect. You do not need a separate construction loan. That's an error. I'll fix that. It is not approved in every state. And then the higher legal costs and soft costs. There are higher legal costs and soft costs as well. So I'm going to end here with just a quick snapshot of a deal. This is actually a transaction that Lundad and I were partnering on. She's a great partner. And we were looking at a transaction in the state of Oregon, about $19.9 million construction loan, and a perm loan of, which varied, as you can see here, it varies depending on which path we went down. So in this instance, every deal is going to look a little bit different, as I've said ad nauseum. But in this instance, we were able to do a side-by-side analysis for them, compare the rates. As you can see, the lowest rate that's offered here is with an MTEB, but the MTEB also has some of the highest costs here. And so the net benefit was the best with the private placement, because while they had the highest costs, they also had the longest amortization. And so we could do a net benefit analysis for any deal that you're looking at. Even if you had a bank quote in hand, we could throw that in here and help you walk through some of the options that you have. If I know that I gave you a lot of information here and I repeated some things, hopefully you found the repetition helpful and not annoying. If you have any questions, always feel free to reach out. I also have a side-by-side comparison of all of these loan programs, along with their pros and their cons, and some snapshots on the terms. Feel free to shoot me an email and I'd be happy to share that with you. And so with that, I'd like to turn it back over to Lundad.
Thank you, Anthea. I will start sharing my screen here. Okay, great overview there. So I'm going to discuss debt strategies for workforce and naturally occurring affordable housing with the agencies and FHA primarily. And then I'll go and discuss briefly debt strategies for seniors housing and care, licensed seniors housing and care in particular. So for workforce and naturally affordable housing, the FHA 223F program, the refinance and purchase program that Anthea also discussed, the terms here will be the same as they would be for market rate properties. But the FHA program still provides the highest leverage and lowest debt coverage and overall best, most inexpensive and most competitive rates in the market for workforce housing. So you can go up to 85% LTV for purchase. If you're doing cash out, refinances can go up to 80% LTV. Debt coverage is 1.176, 35-year AM, 35-year term, flexible prepayment penalty that can be structured as you kind of desire. And processing time about 6 months, and with the queue right now, it could go up to 9. But yeah, if you could tolerate the timing in particular with HUD, you would most likely get away with the highest proceeds and kind of the lowest debt service in the market. And so for Fannie and Freddie, their 2021 multifamily loan purchase cap requires that 50% of their business be mission driven. So this is a cap instituted by their regulator, FHFA. So the definition of mission driven is housing that is affordable for residents at 80% AMI or below, with special provisions for rural housing and manufactured housing communities. So, in the interest of achieving this mission-driven requirement, the agencies regularly provide interest rate pricing benefits for workforce and naturally affordable housing properties that have a higher percentage of their units at a higher affordability. So the higher your affordability, the most likely the agencies would like it, along with, of course, sponsorship and market kind of requirements. So for max LTV, you can go up to 80% for Freddie Mac and Fannie Mae with their workforce housing, naturally affordable housing, for workforce housing, naturally affordable housing, the degree they're not restricted. Debt coverage of 125, amortization periods, typically 30 years, 5, 7, 10 years term typically. So your interest rate could be fixed or floating. The floating rates are actually pretty competitive right now with SOFR as the index, which is near zero, plus a spread. So high lows, high twos, low threes is kind of where these could land today. The shorter the term, kind of the cheaper the pricing. Processing time is about 60 to 90 days. Another program I wanted to highlight is that Bellwether has an internal bridge platform available for value add acquisitions and quick execution need kind of transactions. So this could be used for properties that you're purchasing that you want to lease up or rehab, do light rehab on, and then just add value to the property, and then exit with the agencies or HUD. So the bridge is specifically designed for the most part for deals that will exit to our permanent financing platforms. So the term can go up to 3 years. It's an adjustable rate mortgage, so would have an index plus a spread, very deal by deal and specific kind of review. So if you send us any of your deals, we can kind of review, and the terms can be a little bit fungible in a way. Another program I wanted to highlight that Fannie Mae rolled out this year in March 2021 is the Sponsor Initiated Affordability Program. So with this program, let's say it's a market rate property that's naturally affordable, or a market rate property that the borrower chooses to elect to self-restrict 20% or more of the units at 80% or less AMI, then Fannie Mae will provide such properties and owners with interest rate pricing benefit and underwriting advantages. So the max LTV is still 80% here, but the debt coverage can go down to potentially to 120, depending on a pre-review and case-by-case basis, depending on strong market, deeper affordability, and so forth. And then amortization period go up to 40 years versus the 30-year conventional period, 5 to 30 years term. And so overall, the better underwriting criteria and pricing could incentivize sponsors with better proceeds and overall lower debt service to want to go this route. So it's a new program that was rolled out this year, and at Bellwether we've already done a deal on with this program. So something to consider. So it was designed to support socially responsible investing in conventional properties. And so moving on to construction loan options, again, the 221D4 program that Anthea has gone over, the terms will be the same here as market rate deals. So slightly lower LTV and higher debt coverage than your bond deals. However, still the highest leverage and lowest debt coverage underwriting criteria in the market. So go up to 85% LTV, 1176 debt coverage, 40-year AM, 40-year term plus construction period. And for new construction, regardless of affordability, if the building meets energy efficient requirements, then the MIP would be 25 basis points. So again, rates are in the high 2s, low 3s today with the D4 program, and add to that the MIP, and you'll still have a 40-year, low 3s all-in rate construction to permanent loan. Davis-Bacon wages are required, so that's one consideration, and the timing with the HUD D4 program. The other two programs, so the D4 program is a construction to perm program. The Fannie Mae and Freddie Mac have non-LIHTC forward programs for properties that have affordability but are not necessarily bond deals. And so for Fannie Mae, the affordability requirement is 50% of the units at 80% of AMI, or LIHTC like AMI requirements of 20% at 50% or 40% at 60%, with minimum 10% rent advantage to market. So even if you don't have a low-income housing tax credits in your capital stack or in your structure, if you're willing to restrict your property at these various AMIs, then you could benefit from a forward commitment from Fannie Mae for your workforce housing construction deal. And then, that might get you better responses from banks that would do the construction piece. And then the Freddie Mac requirement for non-LIHTC forwards is 10% of the units and rent and income restricted at 80% of AMI, and then 70% of the units also at 80% AMI, but no deed restrictions required. In addition to the affordability requirement, Fannie Mae also wants public or mission-driven financial investment. So these could be one of many things, not necessarily exclusively these four listed here. So could be subordinate debt from a government-affiliated lender, soft or hard, real estate tax abatements or pilots, low payment, long-term ground lease agreements, mission-driven nonprofit entities providing equity, and anything else that could be potentially objectively mission-driven can can be something worth discussing. And so, yeah, the max LTV for the non-LIHTC programs is 80%, debt coverage at 125, 30-year AM, up to 30 years term, and fixed and floating rates also available here. And then next, I wanted to briefly discuss seniors housing and care, licensed seniors housing and care in particular, not just age restricted. So across the care continuum, memory care, assisted living, independent living, skilled nursing facilities, board and care homes, and so forth. So HUD is the single best permanent financing source for stabilized skilled nursing facilities. The HUD also finances assisted living, memory care, intermediate care facilities. One of the main differences between, in terms of the asset types they finance between HUD and the agencies is HUD does not finance 100% independent living properties. They only finance up to 25% of units within like a seniors housing community. Only 25% of those units can be independent living. Any other combination of memory care or skilled nursing facilities is fine, but only 25% of the units can be independent living. They had some waivers in the past where this could go up to 30%, but really 25% is where the aim is. And this might be a little small, so I'm gonna try to zoom in to talk about some of the requirements. So the target client for HUD is experienced owners of these care communities. And in addition to the owner, the operator also needs to be very experienced because these are operation heavy real estate assets. HUD also, favors entities that have had HUD experience in the past, but if not, at a minimum, surrounded by teams that do have had HUD loan experience. The HUD 232 program also finances, not only finances acquisition and refinances, but also new construction and rehab, although huge scrutiny when it comes to new construction and substantial rehab facilities, just because of the risk metric there. So the term is pretty similar to the multifamily program, 40 years plus for construction, and then 35 years for acquisition or refinance. With the HUD 232 program, if you're refinancing, cash out is not allowed. And if you do a bridge to cash out, so financing it with another source and then taking it out with HUD, then there are some seasoning requirements depending on how much cash you took out. So those are also things to consider. The target LTV is 75 to 85%. So for new construction, maximum LTV is 75%. For nonprofit entities, can go up to 80%. And then for refinance and acquisitions, 80% for for-profit, 85% for nonprofit. Minimum debt coverage is 145 for all the programs. For refinances and acquisition, HUD only finances, so as do the agencies, stabilized properties. And so for Fannie and Freddie, they also mostly finance stabilized private pay, independent living, assisted living, and memory care assets. The other difference in the asset types that the agencies and HUD finance is that Fannie and Freddie will not do 100% skilled nursing facilities. They will only finance communities with 20% or less skilled nursing facility revenue. So that's one of the biggest differences. So for skilled nursing, it's really HUD. For independent living, it's really a Fannie Freddie play. They also have an affordability metric it's not determined by income, because most seniors at that point could be wealthy but have no income. The affordability is determined based on census tract of the project to see if it meets the mission-driven definition. By virtue of that calculation, most facilities do meet them. A significant portion of their revenue meets their mission-driven definition. So to go over some of the metrics here, so the agencies really only finance purpose-built facilities, purpose-built assisted living, memory care, independent living facilities. No construction loan financing option or forward options to date on the seniors housing side. They finance stabilized acquisition, refinance, and provide credit facilities to strong sponsors. And the term of the loan, amortization is up to 30 years, and term goes from 5 to 30 years, 7 to 10 being the sweet spot, also with the healthcare programs. Fixed and floating rates are also available here, kind of mirroring their multifamily programs. The target LTV, especially even though we hope we're at the other end of the COVID pandemic, target LTV is still a little bit lower than their historical maximums. They're getting back up to where they used to finance, but for a majority of independent living, 55 to 75, assisted living kind of on the lower end, 65, but depending on strength of sponsorship and market, can go up to 75. Memory care, we're only seeing them go up to 60% today, but this could change, and on a deal by deal basis, depending on, again, strength of the project, performance during COVID, pre-COVID performance, and so forth, that could be different. And debt coverage requirements are different. Independent living, again, being an asset type that is primarily rent and the services would be laundry and meal provision, is not as risky as or operations heavy and expenses heavy as assisted living, memory care. And so debt coverage requirements on the agency side is 130 for independent living, 140 for assisted living, and then standalone memory care at 145. Pricing wise, another thing to note is the lower the loan amount with the agencies, kind of, they add up pricing and interest rate kind of buffer on there. So an additional certain amount, 10, 20 basis, whatever that might be, during their assessment will be added for lower loan amounts. And then with Freddie Mac, for loans that are less than 7 years, you'd reduce the LTV by another 5%. Minimum occupancy, they're looking at 85% census today. All right, so that is all I had. And you can contact me at my email or cell number here. Happy to share any part of the slides or an even more extensive comparison table on the seniors and workforce and affordable housing presentations. Earlier, I know I may have skipped the introduction there, so I'll just say that I'm based in the DC metro area. Been in the business for almost 10 years, worked with a HUD lender before joining Bellwether, and I'd like to thank everyone for joining us. So I think in the order of how this is gonna go, do we take questions next, our moderators?
Oh, sorry, yes, we will take questions. Folks, if you have, I'm looking through the chat, but if you do have questions, please make sure that they're getting in the chat, and we'll make sure we're tallying them. Um, One of the big questions that came up was if the slides would be available. We will have the slides available on our site. And I think if there's specific ones that people need even sooner, we probably would be able to email them if folks provide their email. Our site was undergoing some construction changes and will be available, I think in the next few weeks. But if there's a rush, we can make sure that we can get the slides over to people. Let's see a new question coming up. So the questions are about slides. Sorry, I'm just going through the questions here. I don't see. Someone asked a question about level of green construction. There was a question about the participation in the LIHTC 9% webinar. I think I put that out there. It's in our chat. There is a link to that registration. Can you provide the recording of the presentation? The commentary would be helpful. Andrea, if you're still on, would the recording be available when our website is up?
We can send the recording out, what has the presentation in it, tomorrow to everyone that participated today. So look for an email that comes from Enterprise Events.
Okay, here is a question. For projects that require Davis-Bacon wages, is there a reference source to know the value of these costs? And what is the percentage in general that it adds to your labor costs?
I can take it, or Anthea, you can take it, I could add. But so the Department of Labor website has, and we could share that link. I have to kind of find it in my bookmarks, but has labor costs based on Davis-Bacon wages for residential, commercial ends based on state and so forth. The percentage cost is, how much does it add? I've heard 10 to 15%. No, no way to really know without actually running the numbers still. But Anthea, anything more?
Yeah, I'd agree with that. I'd say it depends on the location. In general, residential is going to add about 10 and commercial is going to add about 20, but in some states it doesn't add anything because it's essentially those costs are built into the required cost for the state. So it varies, but we could be a resource for you on that as well. Since we do have a servicing portfolio of almost $30 billion right now, we can look into deals that we've done and let you know what the market is.
Lundat and Anthea, I noticed we have some folks who might be from high cost cities. Does that change? Or is there a real outlier in terms of what that add-on is in the district or in San Francisco?
I'm actually going to pass this on to you, Anthea.
So one thing I would say, if you're in a high cost city, if we're talking about HUD, the statutory limits could come into play in a high cost city. But specifically, Monica, you were asking what those add-ons would be. I don't know that offhand. I mean, that'd be something to dig into.
Okay.
So for the DC market in particular, because I'm based in this area, I've seen the Davis-Bacon wages be a deterrent to some developers. Again, adding that 10 to 20%. So it's a good question, relative to rural markets or so forth. But I mean, I'm really mainly seeing deals from high cost markets anyway. So I'm just kind of seeing that 10 to 15%.
Okay.
I will say, if you are a developer that is already subject to Davis-Bacon wages because you're getting some other sort of subsidy from a government agency on your tax credit deal, if you're already paying that extra premium for Davis-Bacon wages, then it really makes sense to consider HUD financing as long as you can stomach the the time.
And then the other thing is, for example, in DC, some big market rate deals have been done with the 221 D4 program, as with Davis-Bacon wages, or sometimes people get into the program with an F, a refinance, or an acquisition, and if you're then building subsequent development next door or on a contiguous, like same borrower property, then you're not subject to Davis-Bacon wages. You can use the supplemental program 241. So that's, probably circumventing of the rules, but it's something that gets done. But yeah, market rate deals, just Davis-Bacon wages, down by the Gallery Place in DC, one of the biggest multifamily buildings were built by HUD market rate recently.
Thank you. I don't see any additional questions coming through. I'm just making sure, I want to make sure we cover. Most folks are asking questions about the slides. Okie doke. Well, it seems like, we book 2 hours for these seminars because we really want folks to be able to engage and ask whatever they deem necessary for their own knowledge base. But we're always happy to give folks back the time. So I really, I don't see anything coming up, and we're down to, I will promptly, always give people back time. Time is like money. Really are appreciative of the participation. Thank you very much, Lundot, Anthea, Andrea Russell, my colleague Jemima Ochere, for helping us to put this presentation together. Again, we invite you to make sure that you attend the other webinars as you see fit. I've provided a link for an upcoming one in August on tax credit executions, which will really be just as excellent as this one. Look forward to seeing folks again. And again, thank you for participating in Enterprise's Equitable Path Forward programming. Look forward to staying connected and making sure that we can answer your questions in the future. Take care, everyone, and have an excellent rest of the week. Thank you, guys.